Something unprecedented just happened in the silver market, and if you're not paying attention, you're about to miss one of the most explosive moves in precious metals history. Silver just smashed through its all-time high. We're talking about a metal that hasn't seen these levels in over 4 decades, but here's what nobody's telling you. This isn't just another bull run. This is a structural breakdown of the entire silver supply system. And the Federal Reserve, despite all their tools and interventions, can't stop what's coming. Let me show you exactly what's happening behind the scenes. Right now, silver is trading at record highs above $54 per ounce. That's a decisive breakout through resistance levels that have held for years. But the price action is just the symptom. The real story is what's happening in the physical market, and it's absolutely terrifying for anyone on the wrong side of this trade. The silver market has been in a structural deficit for 5 consecutive years. Think about that. 5 years where demand has exceeded supply. 5 years where the gap keeps widening. 5 years where inventories have been quietly draining. And now we're seeing the consequences play out in real time. Here's where it gets interesting. The COMEX, the major exchange where silver futures trade, is experiencing something market veterans call a squeeze. Physical silver is becoming increasingly difficult to source. Delivery delays are mounting, premiums are spiking, and the paper market, where most silver trading happens, is starting to disconnect from physical reality. Let me explain how we got here, because this didn't happen overnight. Industrial demand for silver has exploded. We're not talking about jewelry or investment coins. We're talking about solar panels, electric vehicles, 5G infrastructure, and advanced electronics. Silver is the most conductive metal on Earth. It's irreplaceable in modern technology. And as the world electrifies, silver consumption is going parabolic. Solar panel production alone is consuming massive quantities of silver. Each panel requires about 20 grams of silver. Sounds small, right? But when you're manufacturing hundreds of millions of panels annually, that adds up fast. And solar installations are accelerating globally as countries race toward renewable energy targets. Electric vehicles use significantly more silver than traditional cars. The average EV contains about 25 to 50 grams of silver in various components. As EV adoption accelerates, that's millions of ounces of additional annual demand that didn't exist a decade ago. Then, there's 5G infrastructure. Every 5G base station requires substantially more silver than 4G equipment. As telecommunications companies roll out 5G networks worldwide, they're consuming silver at unprecedented rates. But here's the problem. Silver mining hasn't kept pace. Most silver comes as a byproduct of other mining operations. About 70% of silver production comes from mines, primarily extracting copper, lead, or zinc. Silver is just a secondary output. So when those base metal prices are weak, mining companies cut production. And guess what? We've seen years of underinvestment in mining capacity. Primary silver mines, the ones specifically targeting silver, face their own challenges. Ore grades are declining, costs are rising, environmental regulations are tightening, and discovering new economic silver deposits is increasingly difficult. The easy silver has already been mined. This creates a supply crunch that can't be solved quickly. You can't just flip a switch and produce more silver. Bringing a new mine online takes years and hundreds of millions of dollars in capital investment. And with silver prices historically suppressed, there hasn't been sufficient incentive to develop new capacity. Now layer on top of this the investment demand. Retail investors are waking up to silver's potential. Exchange-traded funds backed by physical silver are seeing massive inflows. Coin and bar sales are surging. People are moving money out of traditional assets and into tangible stores of value. And unlike gold, silver is affordable for average investors. You can build a meaningful position without needing tens of thousands of dollars. But the real game changer is institutional money. Central banks have been accumulating gold for years. Everyone knows that story. But what's flying under the radar is the growing institutional interest in silver. Hedge funds are taking positions. Family offices are allocating capital. Sovereign wealth funds are diversifying into silver. These are players with billions of dollars who can move markets when they decide to act, and they're acting now because they see what's coming. The Federal Reserve is trapped. They've painted themselves into a corner with over a decade of monetary experimentation, massive money printing, zero interest rates, quantitative easing programs that ballooned their balance sheet to unimaginable levels. And now, despite their attempts to tighten policy, the underlying fundamentals haven't changed. The dollar is weakening, not crashing but steadily losing purchasing power. And when the dollar weakens, commodities priced in dollars become more attractive. Silver, being both an industrial metal and a monetary metal, benefits from both sides of this equation. Here's what makes this situation explosive. The paper silver market is enormous compared to physical silver available for delivery. The COMEX has a fractional reserve system. For every ounce of physical silver in their vaults, there are multiple claims on that silver through futures contracts. This works fine when everyone's playing the paper game, but when holders start demanding physical delivery, the system breaks down. And that's exactly what's happening. We're seeing increased delivery requests. Traders who normally roll their contracts forward are instead standing for delivery. They want the actual metal, not just paper promises. And the COMEX is scrambling to source physical silver to meet these demands. London is experiencing similar pressures. The London Bullion Market Association, the other major silver trading hub, has seen its inventories decline significantly. Physical silver is flowing out of vaults faster than it's coming in, and while there's been some temporary relief as supplies flow in from the United States and China, the underlying structural imbalance remains. Think about what this means. The two largest silver trading centers in the world are both experiencing supply stress simultaneously. That's not a coincidence. That's a systemic issue. Now, let me connect this to something that affects you directly. If you're holding retirement savings in traditional accounts, you're exposed to this monetary instability whether you realize it or not. Your 401k, your IRA, your pension, they're all denominated in dollars. And as the dollar's purchasing power erodes, so does your retirement security. This is why sophisticated investors are diversifying into hard assets. They're moving a portion of their wealth into tangible stores of value that can't be printed or devalued by central bank policy. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if preserving your purchasing power matters to you. All right, back to this silver squeeze. The mechanics of what's happening are fascinating. In a normal market, when prices rise, it incentivizes increased production. Miners ramp up output. Recyclers process more material. Supply increases to meet demand, but silver isn't responding normally. Production is constrained by the factors I mentioned earlier, and recycling, while it provides some supply, can't fill the gap. Most silver used in industrial applications is consumed in tiny quantities spread across millions of products. It's not economically viable to recover silver from a single solar panel or circuit board. So that silver is effectively lost from the supply chain. This means the deficit is structural, not cyclical. It's not going away when economic conditions change. It's baked into the fundamental supply-demand dynamics of the silver market. And here's where it gets really interesting: the historical precedents. Look back at 1980. Silver hit $50 per ounce during the Hunt brothers squeeze. That was a deliberate attempt to corner the market. It ended badly for the Hunts, but it proved that silver could reach extreme prices when physical supply becomes constrained. But this time is different. This isn't a manipulation by a few wealthy individuals. This is organic demand from multiple sources converging simultaneously. Industrial consumption, investment demand, and monetary uncertainty all hitting at once. In 2011, silver briefly touched $49 during the aftermath of the financial crisis. That was driven primarily by investment demand as people fled traditional assets, but industrial demand was still recovering. The economy was weak, and yet silver nearly reached $50. Now we have strong industrial demand, growing investment demand, and increasing monetary uncertainty. All three drivers are aligned, and we've already exceeded those previous highs. The question isn't whether silver goes higher. The question is how high and how fast. Some analysts are projecting silver could reach $75 to $100 per ounce in this cycle. Others think that's conservative. When you look at the supply deficit, the industrial demand trajectory, and the monetary backdrop, triple-digit silver isn't unrealistic. But here's what you need to understand. This isn't financial advice. I'm not telling you to buy silver. I'm showing you what's happening in the market and why it matters. The Federal Reserve's loss of control over silver is symbolic of a larger issue. They've lost control of the narrative around inflation. They've lost control of long-term interest rates. They've lost control of the dollar's trajectory. And now they're losing control of hard asset prices. Silver is just the canary in the coal mine. When a commodity market this size experiences a structural squeeze, it sends ripples through the entire financial system. Banks that are short silver face potential losses. Mining companies that hedge their production are scrambling to cover positions. Industrial users are panic buying to secure supply, and investors are piling in, afraid of missing the move. This creates a feedback loop. Rising prices attract more buyers. More buyers create more demand. More demand pushes prices higher, and the cycle accelerates. The only thing that can break this cycle is either a massive increase in supply, which isn't coming anytime soon, or a collapse in demand, which would require a severe economic downturn. Neither scenario seems likely in the near term. So what does this mean for you? If you're an investor, you need to understand that traditional portfolio allocation strategies might not protect you in this environment. The classic 60-40 stock-bond portfolio was designed for a different era, an era of stable currencies, predictable inflation, and central banks with credibility. We're not in that era anymore. The rules have changed, and the investors who recognize this early are the ones who will preserve and grow their wealth through what's coming. Silver represents a unique opportunity because it's both undervalued relative to gold and essential for the technological transformation happening globally. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically elevated. It's been trading in the 70s and 80s when the historical average is closer to 50 or 60. As silver catches up to gold, that ratio will compress. And that means silver has the potential to outperform gold significantly in percentage terms. But beyond the investment case, there's a deeper story here about the nature of money and value. For thousands of years, silver was money. It was the currency of common commerce, while gold was reserved for large transactions and wealth storage. Silver coins circulated in every major civilization. The word for money in many languages derives from the word for silver. Then in the 20th century, governments moved away from silver-backed currency. They demonetized silver, removing it from coins and replacing it with base metals. This was presented as progress, as modernization. But what it really did was remove a constraint on government spending. Without silver backing the currency, governments could print unlimited amounts of money. They could finance wars, welfare programs, and political promises without the discipline imposed by a finite money supply. And for decades, this seemed to work. The economy grew. Living standards improved. People forgot that money used to be backed by something tangible. But now, the consequences are becoming apparent. Decades of monetary expansion have created massive debt burdens, asset bubbles, and wealth inequality. The purchasing power of the dollar has declined dramatically. What cost $1 in 1970 now costs over $7. Silver's resurgence isn't just about industrial demand or investment flows. It's about a return to real money. It's about people recognizing that paper currency is only valuable as long as people have confidence in the issuing government, and that confidence is eroding. Look at what's happening globally. Countries are moving away from dollar dependence. The BRICS nations are exploring alternative payment systems. Central banks are accumulating gold at the fastest pace in decades. Trade is increasingly being settled in currencies other than the dollar. This is de-dollarization in action. And as the dollar's role as the global reserve currency diminishes, hard assets like silver become more valuable. The Federal Reserve can print dollars. They can manipulate interest rates. They can buy bonds and mortgage-backed securities. But they can't print silver. They can't create industrial demand out of thin air. And they can't stop people from recognizing that tangible assets have intrinsic value that paper currency lacks. This is why the silver squeeze matters. It's not just about one commodity market. It's about a fundamental shift in how people think about money and value. And the timing couldn't be more critical. We're entering a period of significant economic uncertainty. Inflation remains elevated despite the Fed's attempts to control it. Recession risks are rising as higher interest rates impact economic activity. Geopolitical tensions are escalating, and the political environment is increasingly unstable. In this context, silver offers something that stocks, bonds, and cash don't: tangible value that exists independent of any government or financial institution. You can hold silver in your hand. You can store it securely. You can't be deplatformed from silver. It can't be frozen by a bank. It can't be inflated away by a central bank. It simply exists as a store of value and a useful industrial metal. This combination of properties makes silver uniquely positioned for the current environment. But here's the challenge. Most people won't act until it's too late. They'll watch silver rise from $50 to $60 to $70 per ounce. They'll read articles about the squeeze. They'll hear stories about people who made fortunes, and they'll think about buying. But by then, the easy gains will be gone. The risk-reward will be less favorable. And they'll have missed the opportunity to position themselves early in a major trend. The time to pay attention is now. Not when silver is making headlines on mainstream financial news. Not when your neighbor is talking about their silver profits. Now, when the structural imbalances are clear but the crowd hasn't caught on yet, this is how generational wealth is built, by recognizing major trends early and having the conviction to act while others are still skeptical. The silver squeeze isn't a short-term trading opportunity. It's a multi-year trend driven by fundamental supply-demand imbalances that can't be resolved quickly. Industrial demand will continue growing as electrification accelerates. Investment demand will increase as monetary uncertainty persists, and supply will remain constrained by the realities of mining economics. These forces are converging to create what could be the most significant precious metals move of this generation. And the Federal Reserve, despite all their power and resources, can't stop it. They can't print silver. They can't mandate increased production. They can't suppress physical demand through monetary policy. They've lost control. The question is, what are you going to do about it? Are you going to watch from the sidelines as this historic squeeze unfolds? Or are you going to position yourself to benefit from what's coming? The choice is yours. But understand that doing nothing is also a choice. It's a choice to remain fully exposed to dollar devaluation. It's a choice to ignore the structural changes happening in commodity markets. It's a choice to hope that somehow, despite all evidence to the contrary, everything will work out fine. History suggests that's not a wise bet. The investors who thrive through periods of monetary instability are the ones who recognize reality early and adapt accordingly. They don't wait for permission from financial advisors or confirmation from mainstream media. They look at the data, understand the trends, and make informed decisions. Silver is telling us something important right now. It's telling us that the old system is breaking down, that paper promises are being questioned, that tangible assets are being revalued, that the Federal Reserve's control over markets is slipping. The squeeze is just beginning. The structural deficit will take years to resolve. Industrial demand shows no signs of slowing. Investment flows are accelerating, and the monetary backdrop continues to deteriorate. This is the setup for a historic move in silver prices. Not a quick spike that reverses, but a sustained bull market driven by fundamental factors that can't be easily changed. The Fed has lost control of silver, and that's just the beginning of what they're going to lose control of as this decade unfolds. Pay attention, do your research, understand what's happening, and make decisions that protect your financial future. Because what's coming next in the silver market is going to shock a lot of people, but it won't shock those who were paying attention to the warning signs. The squeeze is on, the deficit is real, the demand is growing, and the supply isn't coming. Everything else is just noise.